Meet our proprietor. They run a non-manufacturing business, an electronics dealer who buys televisions and sells them in their original form. It's the last day of the accounting year. They've sold TVs, paid rent, and drawn cash for themselves. They look at their bank account and the balance is positive. Does that mean they actually made a profit? Judging success by a bank balance is risky. Cash on hand does not account for debts owed to suppliers, the depreciating value of the store's fixtures, or those unsold boxes of TVs sitting in the back room. To see the true financial reality of the business, we have to move past the bank statement and prepare the formal final accounts. This reality is measured using two distinct tools, the income statement and the position statement. The income statement calculates total profit or loss accumulated over the financial year. The balance sheet captures the status of assets and liabilities on one specific closing date. Only by combining this moving picture of performance with a static snapshot of position can an owner determine if the business is actually thriving. Before calculating profit, every raw transaction, every receipt and invoice must pass through a strict filter of basic accounting principles. The first rule separates personal from business. The proprietor's personal expenses are strictly blocked from entering business income calculations. Next, we distinguish between capital and revenue. We separate the purchase of a long-term asset, like a delivery truck, from a daily operational expense, like the fuel needed to run it. Then there is the current period rule. Only transactions completed before the close of accounts are recognized. An uninspected pending sale is not counted until the transaction is officially concluded. These filtering rules act as the law, preventing owners from artificially inflating their profits or obscuring the business's actual state. With the data filtered, we can apply the most critical rule for calculating accurate profit, the matching principle. This principle requires that we only deduct the specific expenses incurred to earn the specific revenue recorded during this year. For instance, if the business bought 10 TVs but only sold 8, they cannot expense the cost of all 10 against this year's sales. The cost of the 2 unsold TVs is set aside as closing stock. It is carried forward as an asset to be matched against the revenue it earns next year. The matching principle forces the numbers to reflect the actual cost of doing business, rather than just the timing of cash payments. We calculate the first level of profit in the trading account. On the debit side, we record the opening stock, net purchases, and direct expenses. Direct expenses are the costs required to bring goods to their current location and condition, items like freight, carriage inwards, and direct wages. On the credit side, we record net sales and the closing stock. The resulting balance is the gross profit. This proves whether the core activity of buying and selling goods is profitable before any administrative costs are added. Does this gross profit reflect the final gain for the year? Not quite. The gross profit carries down to begin the second section, the profit and loss account. Now we deduct indirect expenses on the debit side. This includes office rent, advertising, and financing costs. We also factor in adjustments for outstanding salaries and depreciation, which represent expenses that have occurred but haven't necessarily been paid in cash. What remains is the net profit, the final measure of the business's operational success for the period. We now move from the moving timeline of operational performance to capture the frozen reality of the balance sheet. The balance sheet lists what the business owns, its assets, against what it owes, its liabilities and capital. Net profit flows directly here, increasing equity. Year-end adjustments, like closing stock, appear here to ensure the accounting equation remains in perfect balance. When the balance sheet balances, it confirms the internal consistency of the accounting equation, signaling that our records of ownership and obligation align. Preparing final accounts is the process of translating a year of disparate transactions into a definitive summary of the business's health. This system is built for a trader who buys and sells goods in their original form. These rules govern the simple purchase and sale of inventory, but the logic changes when a business begins converting raw materials into finished products. Manufacturing introduces a new layer of complexity, requiring an entirely different set of financial statements to track the cost of production. Look at that top-line number on your trading account, a massive gross profit. It feels like you've made it. But that wealth shrinks quickly until you remember you still have to pay rent, salaries, and the electric bill. To find out what you actually get to keep, we need a new financial filter, the profit and loss account. This is where we capture all the non-trading revenue, expenses, and losses for the current year. On this profit and loss T account, the process begins on the credit side, inheriting gross profit from your trading account. To move that money, accountants use closing entries. We specifically debit the trading account and credit the profit and loss account. Establishing this starting balance is only step one. Now that gross profit must run the gauntlet. We have to strip away the operational noise to find the actual money the business generated. On the P&L debit side, expenses are grouped by function: administrative, selling, and financial. But not every check gets past this filter. For sole proprietors, personal income tax and personal car usage are rejected. These bypass the P&L entirely, going straight to the capital account. These personal items are considered drawings. Because they aren't business operations, they are treated as direct reductions of your capital rather than business expenses. You also have to track how you treat discounts. Trade discounts for bulk orders are already adjusted in sales, so we ignore them here. But cash discounts allowed for early payments are a debit loss. Cash discounts you receive are a credit gain. And if you give a customer an end-of-year rebate for hitting a purchasing target, that hits the debit side too. The debit side acts as a strict border guard. It ensures only your true, business-related operational costs erode that initial gross profit. Operations don't neatly stop on December 31st. Using the matching principle, we isolate finances into a strict 12-month window. We pull outstanding expenses and accrued incomes backward into the current year's P&L. Conversely, prepaid expenses and advance incomes are pushed forward into the future. We also adjust opening inventory, direct expenses, and closing stock, ensuring only the materials actually consumed during the year hit the expense account. And crucially, all of these specific time freeze adjustments are completely reversed at the start of the next year. By artificially freezing time, these entries ensure the final profit accurately reflects only the effort, income, and expenses of that specific 12-month period. We have to account for unpredictable variables. Customers don't always pay their bills. When all hope of collecting is lost, it becomes a bad debt, a direct loss hitting the debit side. Though if a bad debt is miraculously recovered later, we record that as a gain on the credit side. We know some future losses are inevitable, even if we don't know exactly when they'll hit. Using the principle of prudence, we create provisions, a financial buffer to absorb those expected blows. Look at how we calculate the provision for bad and doubtful debts. We take our total trade receivables, factor in existing old provisions, and multiply the balance by a set percentage. This gives the exact required provision to debit from this year's profit. We apply this same logic across the board. We create provisions for the depreciation and wear and tear of our office equipment, and other provisions for pending liabilities, like a compensation payout for a late delivery. Then there are true surprises, like abnormal losses from a fire or a break-in. If your inventory is destroyed, the P&L only takes the hit for the exact amount not covered by your insurance company. These provisions and loss adjustments act as final defensive shields. They ensure you aren't overstating your success before dealing with the realities of doing business. With the gauntlet complete and our time adjustments locked in, we weigh the two sides of the account against each other. On this T account scale, credit incomes outweigh debit expenses. The balancing figure to equal them is our net profit. We execute the final closing entry, debiting profit and loss and crediting the capital account, passing earnings directly to the owner. That massive top-line gross profit, filtered through categorized operational costs, time-matched adjustments, and future-proofing provisions, just to find this one true number. But knowing your exact profit for the year still doesn't tell you the total wealth or the actual net worth of the business today. To see that, we have to take our remaining assets, our provisions, and our newly updated capital and assemble them into the ultimate financial snapshot: the balance sheet. It is March 31st, the close of the financial year. The shop doors lock, the open sign flips to closed, and physical operations stop. But for the accountant, the real test is just beginning. The year's financial data has been gathered into the trial balance. It is a long list of debits and credits, seemingly tied up in a neat bow. This is the starting line for drafting the final accounts. It is tempting to look at those numbers and assume the job is nearly done, that compiling the final accounts is a simple copy-paste exercise from one column to another. But the real world is chaotic. Goods are damaged. Customers take items home on approval but haven't decided to buy them, and business owners take inventory for personal use. None of those events are captured in that raw, unadjusted trial balance. Because of this, standard accounting procedure requires a strict intermediate step. You must calculate every necessary adjustment on rough working sheets and apply their effects to the trial balance numbers before drafting a single line of the final accounts. Skip that step, and your balanced ledgers are a mathematical illusion. They will add up perfectly, but they will completely fail to reflect the true financial reality of the business. Let's look at the first major physical disruption: abnormal loss. Say a sudden warehouse fire damages a significant portion of your inventory. The foundational fix requires you to physically reduce the recorded inventory. You do this by debiting the abnormal loss account and crediting the purchase or trading account. But that calculation gets complicated if your inventory is insured, because the insurance company rarely covers the entire cost of the damage. If a fire destroys $6,000 in goods and insurance covers $4,500, you split the difference. The $4,500 routes to the balance sheet's asset side as an insurance claim. The unrecovered 1,500 rupees is debited directly to the profit and loss account. The second anomaly happens when goods are sent to customers on an approval or sale or return basis. By the time March 31st rolls around, if the customer hasn't explicitly approved the purchase, it is not a sale. If you already recorded it as one, you have to pass a reversal entry, debit your sales account, and credit trade receivables. But those items still belong to you. The necessary second step is adding those exact goods back into the amount of your closing stock, recorded strictly at their original cost price. The third disruption is internal usage. Goods pulled for free samples, making a donation, or taken for personal use. The universal rule here is subtraction. You subtract the value of those goods from the purchases account and then debit the specific corresponding head, whether that's drawings, free samples, or building construction. By systematically correcting for warehouse fires, unapproved customer returns, and internal usage, you reconcile the math with the physical world. This is the only way to ensure your gross profit calculation is accurate. There is one final complex adjustment that happens at the very bottom of the ledger: calculating a manager's commission based directly on net profit. The difficulty comes down to the exact wording of the employment contract. The wording dictates which of two distinct mathematical formulas you have to use. If commission is based on net profit before charging, multiply profit by the rate over 100. If it's after charging, the denominator shifts to 100 plus the rate. Finally, debit commission in the profit and loss account and credit commission payable. Executing this specific formula satisfies the contract and locks in the true net profit, officially closing out the profit and loss phase of your accounts. Everything we've done funnels into the final destination of the accounting cycle, the balance sheet. Notably, this is a statement, not an account. There are no debit or credit sides here. It operates on the as-at rule. Because a single transaction alters your cash or inventory, the equilibrium is true for one specific frozen point. Structurally, your assets sit on the right, ordered by how easily they can be liquidated. On the left are capital and liabilities, split clearly between short-term obligations and long-term debts. But operations don't stop forever. What happens on the morning of April 1st, the day after the final accounts are closed? You create the opening entry. The finalized closing balances of your assets and liabilities from yesterday's balance sheet become the very first journal entry of the brand new year. Correctly applying adjustments is how a sole proprietor ensures their books reflect reality. But the math shifts again when multiple owners step in to share the capital and risk. Next, we'll see how these rules adapt for partnership accounts. It's the end of the financial year, and you are looking at a massive profit number. It feels like a total victory for the business. But that number comes from a raw list of balances called the trial balance. It completely ignores unrecorded events, like broken machinery sitting idle in the warehouse and utility bills that simply haven't been paid yet. Before we can even start fixing the end of the year, we have to accurately open it. The process begins on April 1st by carrying forward the leftover realities of the past 12 months. This diagram shows how we build that opening entry. On the left, we debit all the active asset balances, like cash, inventory, and receivables. On the right, we credit the corresponding liabilities and the owner's capital to balance the scales. Fast forward back to the end of the year. The first major numerical hurdle hidden inside the trial balance is calculating the exact goods and services tax, or GST, liability. Looking at this flowchart, you can see the step-by-step logic. The business applies its input tax credit to offset the integrated GST first. Once that is clear, the remaining credit cascades down to cover central and state GST. Whatever is left over at the bottom of the chain is the actual tax payable in cash. With those opening balances carried forward and the baseline taxes settled, the real investigative work begins, hunting for human errors. Throughout the year, people make mistakes. These errors break the raw records and require specific rectification entries to reverse the damage. A classic example is a typewriter purchased for the office that mistakenly gets debited to the purchases account. That artificially inflates the cost of goods sold. To fix it, you have to strip that value out of purchases and add it to office equipment where it belongs. Or take wages paid specifically for installing new plant and machinery. If a clerk routinely debits that to the general wages account, the asset is undervalued. That installation cost must be capitalized into the machinery itself. Once the recorded errors are fixed, you have to account for things that were never recorded at all. These are the 15 crucial year-end adjustments. This matrix organizes those 15 adjustments into 4 categories: timing differences, value changes, owner dealings, and anomalies. The golden rule is strict. Unlike trial balance items, adjustments have a dual aspect. They split and impact 2 different places to keep the accounting equation intact. By combining rectifications of the past with adjustments for the present, the accountant creates a verified set of records ready for reporting. With the present sorted, there is one final step before assembling the accounts: estimating the impact of the unknown future. This is where provisions come in. A provision is a mandatory charge against your current profits to cover a known liability, even if you have to estimate the exact dollar amount. A common example is setting money aside for bad debts you expect won't be paid. By law, these provisions must be recorded. They reflect a true expected loss in asset value, and you have to book them even if doing so pushes the business into an overall loss for the year. A reserve works entirely differently. A reserve is an appropriation of profit. It is money actively set aside from your surplus for general future growth, not to cover a known liability. If management takes that reserved money and actively invests it in outside realizable securities, it officially becomes a reserve fund. Provisions protect the business from known incoming threats. Reserves secure its long-term prosperity. Now we reach the final architectural step, taking all this adjusted, error-free data and building the 3 pillars of the final accounts. This animation shows the construction of the trading account. It funnels opening stock, adjusted purchases, and direct expenses against total sales, calculating a precise gross profit block of $718,000. That gross profit block then slides down to form the foundation of the profit and loss account, where it meets a new set of variables. By deducting indirect costs like administrative salaries, outstanding rent, and our provisions for bad debts from that gross profit, the math reveals the ultimate net profit. Finally, the remaining variables assemble into the balance sheet. Adjusted assets stack on one side, while liabilities and the newly updated capital stack on the other. If the investigation was thorough, the scale perfectly balances at exactly $2,380,000. The initial trial balance has been fully processed. Through rectifications, adjustments, and provisions, the final accounts now reflect the true financial position of the business. But this process is designed for a sole proprietor. What happens to the math when a single business owner expands into a multi-owner partnership, and those liabilities have to be shared? The primary goal of preparing final accounts is to provide a true and fair view of a business's performance. But that view comes with strict, legally permitted blind spots. Accounting rules mandate we report assets based on historical cost. A house bought for 15,000 rupees in 1980 might be worth 30 lakhs today, but the balance sheet will stubbornly report the original 15,000 rupees, completely ignoring decades of inflation. The records also omit some of a company's greatest strengths. A highly capable staff with deep loyalty to the firm generates massive value, but because human brilliance cannot be quantified in rupees, the balance sheet ignores it entirely. Accountants operate under the going concern assumption, the idea that a business will exist forever. Because of this, they systematically distribute massive upfront costs across several years based on the expected benefit. This ensures costs are spread out, even if the cash was spent entirely on day one. Comparing two competitors reveals another gap in the system. One management team might slowly build a dedicated pension fund for its staff, while another decides to just pay those expenses out of pocket as they occur. Both policies are legal, yet they yield drastically different profit margins for identical operations. Because these statements are inherently subjective and constrained by historical costs, accountants can't just tally the bank account and call it a day. They have to apply a strict mathematical set of year-end adjustments to drag the final numbers back into alignment with actual economic reality. This diagram shows the two-level profit calculation for any trading entity. At the top, the trading account measures the direct cost of purchasing goods against the revenue from selling them, producing your gross profit. That block then drops into the profit and loss account below, where indirect operating expenses are deducted to reveal the final net profit. To get accurate profit, we have to filter raw cash flow. If a customer pays in advance for next year's magazine subscription, that money is ejected sideways. Advance income is an obligation to deliver future value. It is a liability, not current revenue. The exact same logic applies when cash leaves the business. If you pay your insurance premium a year in advance, you haven't consumed an expense. You've simply purchased a future benefit. That prepayment stays on your books as an asset with a debit balance. Conversely, consider a team that works a 12th month but hasn't been paid by the March 31st cutoff. That outstanding salary must be added to the profit and loss account. The cash hasn't left the bank, but the cost of operating for the full year has been firmly incurred. This process relies heavily on the principle of conservatism, which demands we record known future losses before they happen. That is called a provision, like setting money aside for bad debts. Do not confuse this with a reserve fund, which is actual retained profit invested in outside securities. These accrual and prepayment adjustments function as a matching mechanism. They ensure that every expense incurred is paired directly with the revenue it helped generate, providing a clearer look at economic performance than a simple cash tally. When it's time to draft the final accounts, the trial balance gives accountants a set of strict rules for exceptions. First, if a depreciation charge already appears inside the trial balance, the asset value has already been adjusted. You bypass the balance sheet and charge it exclusively to the profit and loss account. If a customer suddenly pays back a debt you previously wrote off as bad, you do not credit the debtor's account. That recovered cash is treated as entirely new income. If the business owner makes personal purchases through the company's suppliers, those goods must be stripped out of the business ledgers. They are deducted directly from the total purchases inside the trading account. And paying a proprietor's life insurance premium is never a business expense. It must be debited directly to the owner's capital account, reducing their equity. Strict adherence to these rules builds a necessary firewall. It ensures the owner's personal life cannot leak into the ledgers and distort the true operational performance of the enterprise. Even with perfect ledgers, business owners often fall into a mathematical trap when analyzing profit. They aim for a specific profit margin based on their final selling price, but at the time of calculation, they only know their cost of goods sold. This chart breaks down the conversion. A 20% profit margin on your final selling price requires exactly a 25% markup on your cost. For a 1,600 rupee cost, a 25% markup yields a 400 rupee profit, totaling a 2,000 rupee sale. Once sold, possession transfers. Goods waiting in your warehouse at the buyer's risk are officially sales, entirely excluded from closing inventory. After every adjustment, all remaining balances settle in their final destination, the balance sheet. This document is governed by one foundational equation. Your capital exactly equals your assets minus your liabilities. But pay attention to the two critical words at the top, as at. Unlike the profit and loss account, which captures a flowing year of activity, the balance sheet is a frozen snapshot. It details the exact financial reality of the business on a single isolated day. These accounts provide the essential baseline for business health, moving past raw cash movements to define actual profit. This foundational math remains the same even as the ownership structure evolves, a crucial step before tackling the complexities of partnership accounts. You can ship thousands of units out the door, but until you know exactly what it costs to build them, massive sales volumes do not guarantee a single dollar of profit. A retail trader simply buys a finished product and marks up the price, but a manufacturer's reality is entirely different. They wrangle bulk raw materials, fluctuating energy bills, and assembly lines of half-finished parts. If you try to track this chaos using a standard trading account, the numbers will fail you. A trading account only measures the movement of finished goods and sales. It is completely blind to the raw materials and work in progress sitting on the factory floor. To determine the actual factory costs and reconcile your financial books with your internal cost records, you need a specialized tool, the manufacturing account. Understanding whether a factory is truly profitable requires this dedicated financial engine to capture a product's physical journey, from the moment raw steel hits the loading dock to the second the finished part reaches the shipping day. That journey begins right at the loading dock, where bulk materials first enter the facility. We calculate material usage by adding opening inventory and purchases, then subtracting closing inventory. If the purchases figure is missing, we build a creditor's account. Its balancing figure drops into our equation to complete it. With the raw materials accounted for, the focus shifts to the assembly line, where those materials are physically transformed. Building the product requires direct manufacturing expenses. These are costs incurred specifically for the creation of a saleable product, like the direct wages paid to factory workers, or the royalties paid on each unit produced. But the factory also relies on indirect expenses, also known as overheads. This category is strictly defined as the total cost of indirect materials, indirect wages, and indirect expenses. It is crucial to keep these separate because overheads strictly exclude any direct costs. We also have to divide shared business expenses. Take this electricity bill. The power used by the heavy machinery, say 70% of the total, must slide into the manufacturing account, while the remaining 30% powering the office lights goes straight to the profit and loss account. We also have to account for the gradual wear and tear on the equipment actually doing the work. Since the machinery is essential for production, its depreciation is considered a cost of making the product. If a new machine purchase was originally omitted from the books, that missing 10% depreciation charge must be calculated and assigned to the manufacturing overheads. By systematically sorting every expense to a direct factory cost, an indirect overhead, or the office's operating accounts, this categorization is what eventually reveals the true unit cost of manufacturing. This precise tracking hits a snag when the financial year ends at midnight, but the assembly lines are still full of products that are only half built, what we call work in progress, or WIP. We handle WIP mathematically in the ledger. The value of the opening WIP from the previous year is added to the total cost, while the closing WIP, the unfinished goods at year end, is subtracted. If an error occurs and the closing work in progress is understated, less value is subtracted from the total. Mathematically, this creates an artificial overstatement of the cost of goods manufactured during that period. This diagram illustrates the ripple effect of that error. When the closing WIP shrinks on the left, it forces the cost of goods manufactured to rise on the right. That inflated cost then pushes down the net income gauge, making the business look less profitable than it actually is. Beyond the half-finished products, we have to account for the factory scrap bin. Sometimes a process naturally creates byproducts, secondary items formed from the same raw materials and the same production cycle as the main product, without incurring any extra expenses. Because byproducts are a secondary result of the main process, accounting rules prevent us from overvaluing them on the balance sheet. To stay cautious and accurate, we value them at whichever is lower, what it costs to make them, or their net realizable value, the actual amount they could be sold for today. When these secondary items are sold, the revenue is not treated as general miscellaneous income. Instead, the sale value is credited directly to the manufacturing account, which precisely reduces the total cost of manufacturing the main product. Properly adjusting for the unfinished goods stuck on the assembly belt and the scrap sitting in the bin, ensures that the core manufacturing cost remains completely accurate and free of mathematical distortion. All of this calculation leads to a single physical outcome, the fully finished product, boxed and ready for the customer. Inside the manufacturing account, we have run a grand tally. We've aggregated the raw materials, the direct expenses, and the overheads. We added the opening work in progress, and we subtracted both the closing work in progress and the sale of any byproducts. This entire process yields one ultimate balancing figure: the cost of finished goods. Remember this crucial rule. The manufacturing account exists solely to determine this cost and assess the efficiency of production. It will never show a profit or a loss. This flowchart demonstrates where that number goes next. The cost of finished goods transfers out of the manufacturing account and drops into the trading account. Here, it combines with the total sales figures to finally reveal the gross profit. From there, the gross profit flow into the profit and loss account. It absorbs the remaining office and administrative expenses to yield the net profit, which then drops down to anchor the final balance sheet. Mastering the manufacturing account allows an accountant to translate the physical activity on the factory floor into a precise total cost of production. For a sole proprietor, this replaces guesswork with a reliable calculation of how much they actually spend to create their inventory. But what happens to these financial statements when a factory outgrows a single owner and requires multiple partners to bring in fresh capital? That introduces an entirely different set of rules, taking us straight into the complex world of partnership accounts.